So now, Mr. Goenka, help us understand, those that have not yet looked at bonds at all as a part of their core investment portfolio, who exactly must ideally look to invest in bonds? What is the right kind of retail investor that you believe should definitely look at bonds?
So the short answer is everyone, and I will elaborate on that. When we talk about asset allocation and portfolio, globally in the developed markets, everyone talks about equity and fixed income to be the large chunks of that, right? So we have the 60-40 rule, 60 in equity, 40 in fixed income, or maybe 50 in equity, 30 in fixed income and alternatives. So depending on where you are in your life cycle or your savings, the allocation to fixed income can change, right? So let's say when you're in your 20s and you're trying to build a savings and investment portfolio, and large part could be in equities, but 20% is the minimum allocation everyone from 25 to even 75 should do. What we see is when people start making more or creating more wealth, the allocation to fixed income actually increases. So hypothetically, if you have 100 rupees, you might bet everything in equity trying to, get a rapid return. But when we start making 10 lakhs or 50 lakhs or 1 or 50 crores, you do not want to risk on a higher volatile assets and you want to conserve. So really everyone should be looking at it. People for life goals, it's a great way to save for an education, for a marriage, or in 3 years to 4 years time, if you want to save money and make 10 to 12% returns as you go along.
Okay, a 10 to 12% return over the next 4-5 years, if that kind of a horizon is what you have, then definitely bonds is something that you could be looking at. Now tell us, sir, what are the factors that are currently creating more buzz around bonds at this point in time? Why is everybody interested in talking about bonds at this current stage, sir?
So I will take it back that, people have seen an equity wobble because we're largely equity as an investment country. And I believe some of the small caps and mid caps have gone down by 40 to 50 to 60%. But importantly, you have to remember what is the interest rate cycle we are in. What do I mean by that? Central banks all over the world, and RBI included, hike or reduce rates in a 2 to 5 year cycle. For example, our rates benchmark repo rate was at 6.5% from February 23 for 2 years till 2025. And we are seeing RBI cut rates down to 6%. A lot of observers say they are front loading the infusion of liquidity. And I think this cycle would continue for another couple of years, barring any exogenous shocks. So this is a good timing perspective because if you invest in bonds, the interest rate cycle is in your favor. Not only in India, the recent data from US, where you had a 0.3%, minus 0.3% GDP, which means there was a contraction in GDP. You see the inflation data, and US does lead the direction. The magnitude of rates could be different. And we do anticipate that US would see some rate cutting happening, and then emerging markets like India would follow suit. So the timing from a macro perspective is perfect. You want to invest in an asset class which could give you capital gains. So equity, volatility, people are getting more aware and educated, right? Thanks to platforms, the dissemination of information due to technology is really helping people understand. It's their money. People can self-learn now, right? So hence, equity factors, interest rate cycle, global factors are helping people to move towards bonds and look at it again.
Okay. Now, I think a lot of people will also have this question in mind that when there are other debt options available with me, why should I choose bonds? So what is the USP? What is the added on factor that one should look at bonds vis-a-vis the other debt instruments, sir?
No, so the other so-called debt instruments or the traditional debt instruments, and I'll name a few, is what people are used to.
Yeah.
Most of these debt instruments, whether through pensions or RBI floating rate notes or anything else, have one big disadvantage. They have huge lock-in periods. You cannot get out of that 5 to 7 year or 10 years because traditionally they've been only maybe made for senior citizens who have a very long-term view on that, right? Second problem they are non-transferable, which means even if you want to get out after 5 years of lock-in, there is no way to sell it to somebody else. So hence, investing in corporate bonds, government securities is great because there is zero lock-in. You can buy today, you can theoretically sell in 2 days' time. and you can transfer it, right? So sometimes people want to transfer to their children and things like that. Gift, you can actually give these transactions or bonds, sorry, to your family members. That's why they're so much better. Obviously, it's subject to market liquidity. People should invest depending on their own risk appetite. But these are tradable instruments and they are much better. The second biggest traditional instrument is fixed deposits. The whole country has been doing fixed deposits because our parents and grandparents told us that was
Yes.
the avenue they had to save money and earn something from it, right? Because your bank current accounts give you like 2 to 3%. So fixed deposits is an old mindset. Thanks to, again, the advent of technology, the growth and the learning of the investors, people need to move away because once bank rates go down, the fixed deposit rates have already started going down very rapidly. And bonds take a bit of a time to kind of follow that trend, what we call transmission of rates, right? So traditional FDs are good if you have a short-term horizon, but bonds give you much higher, 2 to 3% higher than FDs, and give you all the flexibility to exit, enter, diversify your portfolio.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and/or default in payment. Read all the offer-related documents carefully.